Welcome to America's Commercial Real Estate Show, your source for market intel, forecasts, and strategies. Hello, I'm Michael Bull. Thank you for being with us. Well, this segment is brought to you by my company, Bull Realty. For customized asset and occupancy solutions, give me a call or visit bullrealty.com. Well, today we're going to talk about the office market. You know, it's been a interesting market with a lot of changes going on in the market. We've all heard about what's been going on with WeWork. But what's happening in the market today, and what are some of the trends and some of the ideas that can really help us perform better as occupiers of space or investors? Please welcome my first guest. Is Barbara Denham, and she's senior economist with Reis. Barbara, good to have you on the show again.
Hi, Michael. Thanks for having me.
Well, Barbara, when you look at the office market overall, how is it really performing right now?
The office market is doing just fine. It's not hitting it out of the ballpark, but you could say it's having a steady batting average just below 300, say. The net absorption this quarter came in at 6.8 million square feet. That was above the last two quarters, so it's a healthy development. And it was just in line with the new construction that came online this quarter, which was 7 million. So the vacancy rate naturally was unchanged. It's been unchanged really for almost 6 or 8 quarters at 16.8%, which is healthy, but certainly not robust. You know, this time, deep into the expansion in the 2000s and the 1990s, we had vacancy rates below 10%. So there is really something very, very different about this expansion, especially when it comes to the office market. The year-over-year effective rent growth is just 2.6%, which again is fine, but it's just about at the rate of inflation. Again, very much in line with previous quarters, but well below healthy, robust rates seen in previous expansions.
Yeah, and it seems with all the job growth we've had, Barbara, and economy really hitting on most all cylinders, you know, that we'd be at a time with that vacancy would be lower, that we'd be below that 10% again. You know, what gives? What do you think is impacting the market that's keeping us at what we look at as kind of, I guess, normal vacancy rate of 16.8%?
Well, there's two things to consider when it comes to job growth. Yes, job growth has been healthy and consistent, although it has decelerated this year in 2019. That said, when you look at the office employment base, it's decelerated even more so. And it has, you see a wide disparity between the markets where we're seeing the highest growth in office jobs and where we're seeing declines. So the difference between, say, the office sector and the rest is you see about 15 markets where there's office employment declines. And those include markets like Omaha, Nebraska, Dayton, Ohio, a few in the Midwest and in the Northeast. So there's a wider disparity between the healthier markets and the weaker ones, whereas when you look at total job growth, you see positive growth everywhere. Low, but still positive. So the markets on the West Coast and in Texas and Florida, that's where you're seeing the most growth. And we're seeing that reflected in the office statistics. Not just occupancy growth, but rent growth is very, very wide. All the 4 healthiest markets in the third quarter were all in California. Oakland, Los Angeles, San Jose, and San Francisco were 1 through 4. And the ones at the bottom, again, were Dayton, Omaha, Hartford, and even Houston was flat. So besides the deceleration, you do see some declines across the country in the office sector. Yeah.
Well, where might there be some opportunities, Barbara, where maybe there's been less new supply planned, but you've seen some kind of healthy occupancy or rent growth? Where might we buy or build today that might be opportunistic?
Yeah, I would go where the tech jobs are. That seems to be driving most of the job growth and certainly most of the better paying jobs. And in terms of the tech jobs, aside from those in California that I mentioned, we see pretty healthy growth in Austin, Texas, and Raleigh, Durham, Seattle, of course, and a lot of markets in Florida doing well. Nashville, Tennessee is always on this list. Charlotte, Atlanta is in the top 10 in terms of year-over-year rent growth. So, there are pockets where you're seeing growth, and most of that growth is tech-related.
Yeah. Well, Barbara, there's been a lot in the news about WeWork and what's been going on there, and it was like everyone was so excited about it, and everyone wanted WeWork and wanted this kind of shared office environment in their buildings. But I guess WeWork's having their issues. So how is it impacting the market? What do you guys see out there?
Yeah, well, so I think one could argue that there's a bit of Schadenfreude out there. All these landlords worried about WeWork and now seeing their demise and kind of licking their chops. But it was still, it's still out there, and it's still a disruptor to the office sector. And it's probably been to the benefit of tenants in that they've introduced a lot more flexibility in leasing negotiations, specifically with respect to terms and, length of leases and escalation clauses, things like that. So it's been a tenant market throughout this expansion, and WeWork is probably a big part of that. That said, they were clearly overconfident, to say it mildly, about their own success and their own model. They overextended themselves, they over-leveraged, and now all of that excess debt and all the deficit is really coming home to haunt them. Their owner is out. A lot of their lease negotiations are in jeopardy. I'm sure a lot of landlords, really want to question their credit deposits and any kind of negotiations, I'm sure, are fraught with a lot of risk right now.
Yeah, it's interesting. Well, Barbara, when you look at cap rates for the office market around the U.S., what are the trends you're seeing there?
Cap rates are flat to rising a bit. I think it's a tough sector to be in. What's so interesting about cap rates right now is, say, 10 years ago, when they were just starting to rise from the heights of the 2000s boom, the off sector was one of the strongest. It was in line with the retail sector and the apartment sector in terms of being worthy investments. And it's still a worthy investment. It's just investors are much more cautious and very conservative about rent projections. And in this expansion, the apartment market certainly is number one, and it's the preferred asset class for any investors because of its strength, its rent growth, its very, very low vacancy rate. And remember, the apartment market has that competitor, which is the housing market. So it's almost recession-proof in respect with when the economy is hurting, people won't buy a home, and they actually demand apartments more. Whereas the office investment is definitely, considered much riskier, as firms do have more negotiation power. They may not extend their lease, or they may even downsize and ask employees to work from home to cut their office expenses. And so it's a riskier bet, but it's still a very safe, conservative bet as long as you price it right.
Yeah, well, that's interesting. We're just taking to market around an $85 million property that's mixed use, and it's a lot of multifamily. And it's interesting the extremely low cap rates we're seeing on this Class A portion of the property. But then there's some commercial, which is a great opportunity, much higher cap rates. So it seems like the beauty's always in the eye of the beholder. Well, Barbara,
Right.
What would you say to our audience in closing about the office market moving forward? What do you expect for the immediate future, at least?
It's all about job growth. As long as we see positive job growth, the office sector should be fine. I don't see rent growth increasing more than the rate of inflation going forward, but we're obviously keeping an eye on both aggregate job growth and then macro or metro level job growth. So you really have to do your homework in terms of where you're seeing these job losses. And this isn't something you're going to see in a standard BLS report, where the office sector is. So like I said, there's at least 10, maybe 15 where we're seeing office declines, and they're the ones you really need to be conscious of.
Right. Excellent. Well, great tips, Barbara. Thank you for being on the show again.
My pleasure. Thanks for having me.
If you'd like more information from Reis, visit their website. It's Reis, Reis.com. And stay tuned. Stay with us. We'll have more on the office market, including some trends and strategies you don't want to miss. Stay with us. I'm Michael Bull. This is America's Commercial Real Estate Show. America's Commercial Real Estate Show is brought to you by Bull Realty. For customized asset and occupancy solutions, visit bullrealty.com. Commercial Agent Success Strategies. Incredible training for commercial agents. Visit commercialagentsuccess.com.